We experienced some rally today. And first, let's talk about today's rally, some pieces we saw that are important to note, and then we'll get into talking about the CPI and things a little bit more medium term. So yes, the market rallied today. It was very choppy, very, very volatile day, I guess you would say. However, despite the up day on the indices level, we still see Apple down, down most of the day, finishing the day just in the green, kind of making that one last second burst of buying. We see Tesla in the red, and to me, this indicates that there's still more downside in these stocks. They are big, expensive stocks. I think Apple's a little bit more expensive than Tesla at this point because Tesla actually can experience some serious growth. I don't know if Apple can really experience the same kind of growth. Now, I get it. Everyone's been saying that kind of thing for years. But I think there's going to be a couple years where Apple is going to be experiencing less of a boom. And I've talked about this, the reasons behind this in past videos. And you can go into past videos and hear full coverage of this. But I'm very convinced of it, and I'm short Apple for this reason. I was previously short Tesla. I'm no longer short Tesla. I'm not a buyer here, but I will be a buyer at a certain level. So, in my opinion, the fundamentals and the valuations and interest rates and prices are really what matters, not necessarily trying to trade the CPI. I think a whole lot of what's going down this week is trying to trade the CPI, trying to trade a number that gets released and benefiting from a rally on that. Now, that made sense when the Fed was not so committed to its path. It made sense that, okay, they're very much data dependent, but here's the thing. We're towards the end of the tightening. There's not a whole lot that's going to change. Yes, 50 versus 25 might be a 25 at the next meeting. I'll grant you that. But unless you're expecting the Fed to be lying to us, I don't think that's the case. And here's the thing. The Fed has been talking all this week, every day. They were talking a lot towards the end of the week. And the message has stayed the same. My assumption is, and they've said about as much, that they get the data a little early. They know what it's going to look like before we get it. And they're talking the way they're talking. I don't think I've ever seen the Fed talk one way, in this unanimous, agreed upon way. Never seen the Fed talk one way and then the next day, basically, because that's what the market is asking for here, at least in principle, change, that a pivot is about to occur. I don't think that's the case. We're seeing yields kind of rise today a little bit. That might be a little bit of not such a recession move. That maybe should have an impact on markets, maybe not, I don't know. We'll get to the recession discussion in a second because there's obviously bulls and bears and two sides to that story. We'll cover both sides of that story in a second. My point here is CPI, yes, it's important. Yes, we technically want to see a lower number. However, it's important with regards to markets because it's supposed to guide what the Fed is going to do. But we know what the Fed is going to do. They're going to hold rates above 5% well into 2024. And the market is not priced for that. It is priced for cuts towards the end of this year. And there's still people who believe the Fed is going to cut towards the end of this year. Now let's get into the recession discussion. People believe the Fed will cut, and the only reason why the Fed will cut will be because there's a recession. Okay, that makes sense. The Fed cuts when it needs to stimulate growth. Stimulation is inflationary, by the way. Today, we got an upward revision to Atlanta GDP. Okay, that is from the Fed. That's a Fed number. Atlanta Fed GDP now. That is certainly a data point that we got to consider. We're seeing a lot of conflicting numbers in the recession camp. We're seeing that number, Atlanta GDP now. We're seeing World Bank say basically a recession is about to occur. We're seeing Lululemon say margins are coming down, inventories are building. We're seeing FedEx talk about not doing as many Sunday deliveries, aka not so much demand. We've seen how that stock is, obviously traded in the long run, in the last years plus. It's a debate still. I would not say we're fully in a recession yet. Obviously, we experienced last year 2 consecutive quarters of declining GDP, but now it looks like we're going to have some positive GDP. I mean, unemployment rate fell to 3.5%. We talked a whole lot about unemployment. So if you want to hear a lot about the unemployment numbers and the unemployment data and our take on it, because we didn't get any new ones today, go to yesterday's video. The market remains quite strong. And the Fed said as much today. Barkin said the labor market, the data reflects that the labor market is quite strong. What does that mean? That means that the labor market is not softening, and the Fed wants it to soften. So we really got to see some progress in that department. I don't think we're seeing that progress yet. That said, I'm saying all these. I'm not viewing everything in isolation. I'm not absolutely dedicated to the idea that stocks need to go lower. I think in the short term, they might go a little bit higher. I think CPI is going to come in nice, possibly, and we get a rally. Possibly, it's possible it doesn't. But ultimately, I think a lot of this CPI move, this move down, has a lot to do with the move down in oil prices, which were synthetic in the fact that they were aided by SPR releases and China lockdowns. Those are both temporary forces. And as of today, the EIA expects a higher number than previously anticipated for oil demand growth. Think about that. Higher number than previously expected for oil demand growth. That is not a fall. That is an increase. And it's a tight market. So that's just going to push prices up more. And I think the Fed is very keenly aware of this, and they have discussed it. So I actually don't think, I know. They talked about it earlier this week. I can't remember who it was. And the Fed's aware. They're aware of the oil price situation and how that really is a big part of why inflation's come down. And without that, I struggle to find much as to why it has come down, because wages are going up still. Yes, they're growing less, but they're still going up. Productivity is low. There's a number of reasons. So ultimately, we have to see what happens. But CPI comes in, and then we have Fed speak. We don't have any more Fed speak until CPI. We finished that with Barkin. I believe it was Barkin. Female, started with B. We got Bullard. He's the hawk. And last time he spoke, said we weren't in restrictive territory yet, but we probably were gonna. So there's some talk about 25. Nobody is saying they're ruling out 50 or anything like that. Nobody's saying they're ruling out 25. But Bullard, I think, will come in, talk about his desire for a 50, and we'll see what happens. That could be the peak. We could get a pre-market rally, and it could be washed away by the Fed. For the next 2 days, it's kind of hard to do anything really. We're just waiting for the CPI data. That's an obvious catalyst. We just got to be positioned the way we're positioned. We got to get the CPI. We got to listen to the Fed. I mean, we know what the Fed's doing, so we got to see what the market does and then either go with that or fight it. Fight the market, not the Fed. And we'll see what happens. And then, we'll get the earnings. We'll go right into earnings season. We'll see how earnings come in. So right now, we're seeing how things go. No gambling. That's the point of this shirt. No gambling. We're doing fundamental analysis here. That's today's video. And until next time, peace out.